So this is just, a diagram here. We have our prices actually on the left-hand side. You can see it started at 15, whatever units you're using, euros, dollars, whatever. But it started at 15, and then our time goes from left to right still as normal. But in the most recent time is to the far right. But here where we see on the right-hand side are the actual Fibonacci levels, or some of the Fibonacci levels we're highlighting, 100, 61.8, 38.2, all the way down to 0 there. And remember, the levels are based on the trading range over a period of time. So if I choose a period of time, and I can choose that period of time when you're using trading platform software, where the Fibonacci levels are going to automatically calculate and need an overload on top of that. So if we simply looked at just a little bit of this here, you can see as we looked at that top, where it's at 100 there, that's telling us that's really at a high Fibonacci level, that we're probably not going to go above 100. That's really a very, very strong indicator, and that we might want to sell at that period. By the same token, as we come off that level, and now we're in more of this trading range up and down, but as we approach that 61.8, that's kind of a support level that's going to support and say, no, we're going to rebound off the bottom of that. And what might then start off the chart as far as what happens over the next days in the future, we're thinking, okay, it's kind of gone a little bit below. As you can see, the little tick mark below 61.8. Now we want to watch to see if it really is more of a support and really tries to go back up, or if it's going to break through that and keep going down as far as that. So you can see there's a couple times when it approaches the support line, that kind of bluish line there at 61.8, where we would be buying, right? It's approaching it and I buy, and I'm not selling because it's still in between, but then it comes down again, there's maybe another buying opportunity. And so we're watching the Fibonacci levels, looking for it to break through and pass through those levels, or bounce off those levels. Basically, we're watching for it to bounce off those levels. Now, if you look at the 15 going to the right, you should see and say, oh, wait a minute here, it's actually gone through those levels. It started at 15, kind of bounced along the bottom, along that 0 range level, that 0%, but then started going up, and it went up to that 23.6, that yellow line, and just burst right through there. They didn't care at all. And then kept going up, and up to 38.2 and burst through that. And it looks like 50% there in purple, and then well past the 61.8. And it just like burst through all those things, broke through all of those. So you can see that the strong trend is going to blow through these resistance levels, these things that resist going through them. And then it gets up to that resistance level of 100 eventually, and then starts coming back down. And then we're looking at the bottom would be support levels. But you can see that when you're watching with Fibonacci, you want to be watching, is it truly going to break through that level, or is it going to come back down off it? And we might use our trading based around that, whether we're putting in a stop loss or we're putting in different types of market trading mechanisms we'll look at. But you can see that's just an example of how that would happen. And one way you can look at that too is the deeper the move, the stronger the Fibonacci indicator. So if we looked at that and we said, okay, 23.6 is not as deep a move, right? It's not as strong a move as, let's say, 38.2 or certainly 61.8 or 100. So there's a better chance that it's going to break through a 23.6 level going upwards than it would, let's say, through a 61.8. By the same token, if it's coming down, like off that top near that 100, and it's coming down to that 61.8, there's a better chance it's going to break through 61.8% going downward versus, let's say, going on down to 38.2. So you can kind of use that as a gauge in terms of strength of what might be happening with this Fibonacci sequence and using this Fibonacci indicator. And so that's why it's best to use Fibonacci, I believe, as a confirming tool with another indicator, right? Now, some people just trade Fibonacci levels, they just truly believe in it, and that's okay. You can, trading with something is better than nothing, at least something more proven like Fibonacci, but I think it's just best to use Fibonacci with another thing to help, confirm it. And then again, you set the time frame, and then you overlay the Fibonacci on the chart, right? So you're the one deciding how many days we're looking back at, and it's going to change your chart and what you might trade based on how many days you look back. So let's look at that with a live, real example here. So if we look at this as a real security here, and I've set the look back period over for 45 days. I know this is periods. I happen to choose days. If you're a day trader, you might choose this as 45 minutes for your Fibonacci level. It would actually come up with this kind of the same thing if this was within, let's say, a day time frame. But I'm choosing 45 days. And you can see where the blue lines, that's when the 45 days look back goes, has I had it set to start right at the kind of the peak there of that of the highest peak. If we were to go back, we could go back another 45 days or go back 90 days or 180 days. Then I'd be capturing more of this longer chart. But with my Fibonacci setting it at 45 days, you can see I'm really starting at that peak, and I'm looking at that to see if I've got a resistance level at 100% and seeing what happens from there and seeing what has transpired before. The current day price would be on the far right there. You see where it says 64.83. So that's what I'm trading at right now, or what I could buy in, let's say, at right now. But you can kind of see how it bounced off that 100% level and then started going through more levels. You see we've got long red candlesticks, so that means it's closing lower than the opening. A little bit of, and then towards the bottom we have a little bit of a trading range in there between 0 and about 38.2%. But now we've gone lower too. So if I was to look at this, interpret this, I'd say, okay, I'm pretty down low, close to my 0 now, at 64.8. It might be, a better chance for an upward move, and I can see even the whole range of that would be up to 75 units or $75. Let's use dollars. As far as that's the number to the right. The first number is 100%, 61.8%. But you can see at the top where it's 100%, that's where we're at about 75.10. So this is looking back over 45 days, and I can base that saying, okay, I can see I've got more upside opportunity maybe than downside opportunity, but I would want to use maybe other indicators to confirm that. But let's say I changed that and I said, I don't want to look all the way back to 45 days. That seems like ancient history now. We're definitely in this more narrow trading range. Let's look back less time. So now I'm going back to more of that trading range, a more narrower range, looking back over 26 days. Because this is really kind of more the range I'm in kind of right now. It had that high, which is a good, $75 might give me an idea of potential. But right now we seem to be stuck more in this range between like $67 and $63. So if I look at it that way, you can see now, and it's a little hard to see when you overlay these sometimes with the volume bars and stuff, but you can see I'm right near that, that 38.2% would be the second line, blue line from the bottom is 38.2. Then it's a 50%, and then you can probably see the 61.8 pretty good, then certainly the 100%. So at 64.83, I'm just right around that 38.2%. Not much more to go break through those other levels, the 50 and the 61.8%. So that would get me up to 60, around $66. It looks like the 66.49. Or excuse me, no, it's not that. It's like 65.49, excuse me. So that's where it can get a little harder to read. But you can see I don't have much to go to break through those upper levels. But I could see all my potential might get me really more towards the 67 if I was looking at this. But the same idea that I'm more towards the bottom part of my Fibonacci, more to the bottom part of these levels. But if I look at it here, I've got more ways to go from the 38.2 to 0 percentages than when I was looking at over 45 days. So that's where the key part with Fibonacci comes in, is setting your time frames, and where you'd want to learn even more about it is around setting time frames. And you can see the concept I'm using here is trying to look at more of a true range or the more recent time versus looking back over the entire chart, or certainly at the peak, and how that changes my Fibonacci levels. And so if we look at both charts side by side and say, well, I want to make a buying decision at the 61.8 level. Let's say once I go above, once I'm below, and I go, I've decided my rule is I want to buy when it hits 61.8 and breaks through that's resistance level, then I'm buying. That's when I'm buying in. Let's say that's what I want to do. I don't want to buy 38.2 because that's not as strong. I want to really have a stronger indicator, so I want to buy at 61.8. So if you look at the longer time frame, the 45-day time frame on the left, and we have the 26-day time frame on the right, you can see that I would be buying at 61.8 once it got up to $70.53, up from 64.83 right now. If I look on the right, I'm still buying at a 61.8 level. It's just I changed my time frame. I'd be buying at $65.49. So what does this say? Is one better than the other? No, it's just different time frames. But you can see that if I'm using these Fibonacci levels, if I have a longer time frame, I'm going to establish more deeper resistance levels, or I'm going to have to prove that price is going to have to prove itself to break through these levels more. And so I'd be buying in later at 70.53. You can see I gave up $5 worth of gains per share of the security by waiting till that, but I would feel more If you're a more, let's say, a little more conservative investor, you'd say, yeah, that's fine. I just want to use this with other confirming indicators and really have this be really clear to me. So I'm going to use a little longer time frame that's really proven the breakthrough of that, whereas I might be looking at a shorter time frame at the 64.83. And if we were to talk a little bit more about Fibonacci as in terms of trading indicators, those time frames are real important. And this is this is just some general terms you could use for a trader's name, a scalper all the way up to a carry trader. There's different ways you can do an active trader or whatever. This came from a nice source that I would point you to on tradingfibonacci.com. I have no investment in them or any connection to them other than I think they're a good site about learning more about trading Fibonacci and really getting into Fibonacci. Now, if you go to that site, understand they're focused on Forex, so they focus a lot on Forex, but they also work in stocks and cryptocurrency too a little bit, but their basis is around Forex. Again, when you're using technical analysis, you can use these tools, Fibonacci, whether you're trading Forex or cryptocurrency like Bitcoin or stock. Those things will all apply. And so when you're setting your time frame, you can see the different time frames. Scalpers looking at seconds and minutes. They're just trying to make really a lot of trades real quick. Day trader, minutes to hours, and then they'll close out at the end of the period, and so on up to carry trader might be looking over 1 to 12 months, right? So you would be setting your Fibonacci levels to kind of match up with maybe those time frames or with those time frames. If I'm a day trader, for example, I'm not going to look over weeks and months. I'm going to look at minutes and hours when I'm looking at my Fibonacci levels. So Fibonacci as a trading indicator, passionate debate for sure. Supporters say it really works and they believe in it and they embrace it, and a lot of them just use only that, and I caution on that, but they do. And so the supporters really believe it and love it and use it. Detractors say, come on, it's just a sequence of numbers done by some old mathematician guy. It's not some mystical trading indicator. In addition, then they do make a point, it can be hard to draw the lines on there, hard to see and interpret them, and understanding what days, your length, your time frame can be a little bit more tricky or advanced. So there is a point there, but that doesn't mean it's not a good, that doesn't work. It just means you have to be a little more practiced with it. So, and sometimes you have things in technical analysis, I think Fibonacci is one, where it can be kind of a self-fulfilling prophecy, right? Where it works because enough traders are using it and they believe it and act on it. So when a Fibonacci level is being approached or being broken through, there are a lot of people who believe in Fibonacci who see that and are doing things based on that. So when that happens, that means they're buying or they're selling based on that, and that's going to actually almost prove the indicator that the indicator is going to work because people are using it. I mean, if we said that every day is a sunny day and stocks or securities or cryptocurrency always rises on sunny days, well, heck, if it was a sunny day, then everybody'd be buying, right? Cloudy days, I guess we'd sell. So that's a little bit unfair to Fibonacci, by the way. It's a lot more detailed than sunny and cloudy days. But you get the idea where it can be a little bit of a self-fulfilling prophecy. And if it is, that's okay. That means we can use it as a real trading tool. And the reality of all this is that any indicator can work some of the time, right? But not all of the time. There's no foolproof indicators. And that's why it's good to pair with another indicator for confirmation. I just really strong on that, especially with Fibonacci. I really believe that. Just using another indicator and then confirm with Fibonacci, whether it's moving averages, candlestick charts, whatever, candlestick price patterns, whatever it might be, just using more than one indicator can be real helpful, particularly with Fibonacci. But if you like to trade Fibonacci, that's fine too. That's where back testing and paper trading can really help to see how your success is. If you're trading only Fibonacci and it's not working out, well, then you just need to change your plan and maybe add a second confirmation thing would be maybe a good thing or a good idea to try.